What is liquidation analysis? Have you ever wondered what happens to a small business when it faces bankruptcy? One key process involved is called liquidation analysis. This financial evaluation helps determine what can be recovered if a company's assets are sold off individually. It is particularly relevant in bankruptcy situations where the business may not be able to continue operating. Liquidation analysis represents a worst-case scenario. It estimates the value that can be generated by converting assets into cash to pay off creditors. This process typically occurs under court supervision during bankruptcy proceedings. In the context of small business bankruptcy, liquidation analysis plays a vital role. It helps assess how much creditors might recover if the company ceases operations. This is different from restructuring efforts, where the business tries to reorganize and keep running. The analysis assumes a fire sale approach. This means assets may be sold quickly and often at a discount. Specialized or customized assets might have limited market appeal, which can lower their recovery value. So, how does liquidation analysis work? First, the debtor's assets are identified and listed. This includes tangible assets like equipment, inventory, and real estate, as well as intangible assets like legal claims. Next, each asset is assigned a recovery rate. This rate estimates the percentage of its book value that could realistically be recovered through a forced sale. Less liquid or specialized assets usually have lower recovery rates. After that, the estimated recoveries from all assets are totaled to calculate the liquidation value of the company. This value is then allocated to creditors based on the priority of their claims. Secured creditors are paid first, followed by unsecured creditors, and finally shareholders if any value remains. Liquidation analysis is essential in bankruptcy cases. It informs the court and creditors whether liquidation is a better option than reorganization. If the liquidation value is higher or more certain than the value of the company continuing operations, creditors may prefer liquidation. From a practical standpoint, this analysis guides decisions about converting a bankruptcy case to Chapter 7. It also helps in negotiating with creditors and sets expectations for what creditors can expect to receive. Trustees and courts use liquidation analysis to oversee the fair sale of assets and distribution of proceeds. In essence, liquidation analysis is a methodical assessment of a debtor's assets. It estimates potential recoveries through asset sales, shaping decisions about the company's fate and creditor payouts during insolvency proceedings.